Hello and welcome to the DIY Investing YouTube channel. We are covering every company in the S&P 500 with a 5-minute stock analysis breakdown. So this is my first 5 minutes doing due diligence on a stock, and today we are discussing Abiomed Inc, ticker ABMD. So this is what I'm going to do. I'm going to walk through each part of the business description here. We're using quickfs.net to get everything we need here. So let's look at quality and valuation. First up, market cap 13.5 billion, EV 12.85 billion. We're in the healthcare and equipment and supplies industry. So what does that mean? They're doing research and development, medical devices. This is key. Medical devices differentiates them from other parts of the medical industry. So it's not pharmaceuticals, it's not hospitals. Heart failure patients, they have Impella 2.5s. This is some sort of device, heat pump or heart pump. A few different versions of this. They also seem to have various ports dealing with the heart system. And so it sells through direct sales, clinical support personnel in the United States, Japan, Europe, Canada, Latin America, Asia Pacific, Middle East. So basically they sell all around the world. So medical device industry is actually seemingly usually a pretty good industry. Medical devices can have relatively long longevity depending upon the part of the market is. And so that's a nice part of the business to be in. And they usually are not high competition once they're embedded. So depending upon where they are in their cycle, it could be an attractive business. Now let's go down. The next thing I like to look at is beta. I'm looking for a beta under 1. Because this is a volatility measure, and so if beta is above 1, then that means it's going to be relatively high volatility, and beta is below 1, that's going to be relatively low. So I'm looking for ideally the lower the better. 1.29, not a good sign. Also share turnover. I want less than 100% share turnover because it means I have longer term shareholders in the stock, more likely to have incentives for management to think long term. We're at a 180%. That's not good. Again, ideally under 50%, but 180%, this is a red flag here. Two things here, not that's great to start. Next, I want to look at return on invested capital. So this is interesting. You quickly look and see that you have an old period of losing money, and then you've basically made money every year since 2012. So this can be okay. Ideally, you'd like it to be 20 straight years of profits. But if you at least have no losses since a certain time period, then this could be like the business starting up. This could be doing R&D, and now that they're selling products, they're getting better returns. So what do we have here? 2012, 1% return on invested capital. 2013, 11, 4, 49, 11, 12, 19, 31, 20, 18. So it's not super stable, but basically since 2015, you've never had less than a 10% return on invested capital. That's attractive. So that's good news here so far in return on invested capital. Maybe they will become more stable over time, just like they became more profitable over time. So let's look at 10-year median returns. Return on assets, 13.7%. Check, that's good. Return on equity, 15.8%. Again, I want higher than 15%. So check, we're in a good spot. And return on invested capital, 15%. So they can achieve the return on equity targets without much debt at all. That's really good news. Now, what I want to know next is valuation when I'm looking at this. So quickly looking, we can see median margins. You have high gross profit margins, 82%. This is pretty normal for the medical device industry. So you're talking a relatively high quality business here, which is driven by margins and stability. High returns on equity, good sign. Valuations. Immediately, this number screams overvaluation. PE of 90 is way too high. I like to buy stuff below 15, but high quality companies you might see in the 20, 25 range, something like that. But it's relatively high. Price to book, 10, extremely high. Price to sales, 14. If it's over 10, it's too high. So I wouldn't buy this stock at this price, but it's looking like it might be attractive of a business. So let's look at our 10-year CAGR, revenue, 23%, assets, 27%. So ideally, you want revenue to be higher than asset growth. But either way, growth rates in the 20% range are outstandingly good. So this is a good sign. Now, because we're interested in the business, but not necessarily the valuation, we want to see stability here. So revenue growth has been pretty strong year over year, 20s, 20, 16, 20, 40, 35, pretty strong. Maybe the last 2 years have been weaker. That could be due to COVID. But let's look at gross margins. 80%, 80%, 79, 82, 84, 84, 83, 83, 83, 2. So these are all very stable. This is a great sign of a good high quality business. Operating profit margins have been growing. So here you're seeing operating leverage going from 1.2% to 27%. Great sign. Earnings per share is at a $4.94. So what would that be on a 15 PE? You're talking about $75 stock. Current stock price, $2.96. So it's way too expensive for me. But for those that are growth investors or high quality investors, this is looking really attractive. All your numbers are looking really attractive here. Because it's attractive, let me extend it a little longer than 5 minutes here, and let's go into and look at the balance sheet or the income statement. Well, I want to look at the balance sheet because it's pretty expensive on the balance sheet. So what we're going to see here is, what did we say this was? This was a $13.5 billion company. So income, you're earning $159 million or $149 million, $226 million. So you're in the multi-hundred million range. Again, it's very expensive. So what you're basically building in is continuing operating leverage. You're also seeing dilution happen over time. So you started at 38 million shares outstanding and you're up to 45 million shares outstanding. So you're diluting over time. Your free cash flow is going somewhere. Let's see the cash flow statement. You're acquiring some PP&E, but you have solid cash flow from operations every year of the last 10 years. That's a good sign. You're investing it. It looks like, I don't know what investments are here, but you are issuing common stock. So not the best sign. And you have a lot of stock-based compensations. Balance sheet. See your debt set up here. So you don't have any long-term debt. That's a really nice setup. This is a good, well set up company, but it suffers from what a lot of is going on here in 2022 of very high prices for high quality companies. All the signs here, all the numbers point to a very high quality company with good promising growth prospects, but you're paying up for it. You're paying a PE of 90. There's no room for error here. You need to have this 10-year CAGR continue for another decade. If you can be sure of that, maybe this works out, but you're going to suffer a huge multiple contraction. I wouldn't buy it, but it does appear to be a high quality company. Thank you for listening to this episode. Don't forget to like the video and subscribe to the channel so you can get more great investing content.